The Property Pod. Welcome to The Property Pod with Moneyweb. The property sector is an ever-changing sector. And in this podcast series, your host, Suren Naidu, chats to movers and shakers in the property industry.
Hello and welcome to the latest edition of The Property Pod, South Africa's premier property investor podcast. My name is Suren Naidu, and on this weekly podcast show, we gain insider insights from leading execs, analysts, developers, and entrepreneurs in South Africa's expansive property industry. The Black Friday and Black Friday weekend sales boom has just ended, with many shopping centres packed. But the festive season is still ahead. We are talking shopping centres on the podcast today, with this being the peak season for them, with commercial real estate services company Swindon Property. We have the CEO, Andrew Dewey, on the line to share some insights. A warm welcome to the podcast, Andrew.
Hi, Suren. Thank you for the invite.
Before we kick off into the topic of what's happening in the shopping centre space currently from your perspective, tell us a little bit about the group and yourself. How long has Swindon been going? How long have you been MD? And does it purely focus on malls?
Thank you. Yes. So the company's been in operation since 2006, which as of January next year will make it 18 years. I founded the business back in 2006, and the initial focus was on commercial and industrial brokering based out of Cape Town. We then expanded into corporate and tenant advisory services, professional valuations, property management, and a live auction platform, a live online auction platform. We now have offices around the country, and we're also the commercial affiliate for Savills London, which is a global real estate firm, and we represent their interests and their clients' interests throughout sub-Saharan Africa.
Thanks for that, Andrew. Black Friday weekend is over, and we're almost into December. Shopping and malls seem to be a key part of society in South Africa. It's part of our culture and we love shopping. Why do you think this is the case?
I think shopping malls in South Africa, especially your regional and your super regional centres, have always served as a place of entertainment or a destination for South Africans. So, if we look at some of the issues we face in this country with high crime rates, there's very few places that you can go and safely park your car and take a walk around and have an entertainment value aspect. So that's one thing to consider. The other is online shopping is obviously a global phenomenon, but it's lagging behind in this country. The reason being is that we're probably sitting at stats of around 45% of retail turnover. Behind that is the high cost of data. We also have issues with last mile deliveries. Our addresses aren't mapped correctly. And then in terms of the data, only out of the 62 million population average, 28 million of those people have internet access. Approximately 21 million use their phones for the access, and a mere 3.5 million engage in online shopping. So I think those factors all play a part in creating an environment which is heavily focused on shopping malls.
Well, it's interesting if you look what's happening with Checkers and Checkers 6060, that, it's bricks and mortar is a key part of their play in that space. So it's fascinating what's happening on that front. What sets South African shopping centres apart from those in other parts of the world? Some would say a shopping centre is a shopping centre, but I ask this because there was talk about the Armageddon of malls with the booming online. Now, I know you said online is not as big as in South Africa as it is in other parts of the world, but this whole Armageddon scenario was a big thing in America, particularly a few years back, and that was even prior to COVID. But SA shopping centres have largely been okay and are doing well again post-COVID, it seems.
Absolutely. I think, other parts of the world, you have a big segment of the market is high street retail, where South Africa has a very small segment allocated to high street. And then you have the other factors like the entertainment value of safe space, the low online shopping statistics, and all of those factors play a part in driving additional development in the malls.
You mentioned resilience in SA shopping centres in a recent comment you made on the industry, even with the load shedding, etc. How are they keeping up and reinventing themselves, as you say?
Yeah, I think the largest centers and most of those are, as you say, owned by the listed sector. They're focusing rather on hospitality as opposed to traditional retail. So they're making a better use of their common areas. They're creating areas of interest throughout the mall with lounges offering Wi-Fi, free Wi-Fi. There's entertainment options like live entertainment, or creating areas to watch the sporting events. I mean, during the World Cup, I think a number of the super regional centres had big screens, showing all the big matches. So they're converting all those underutilized and redundant spaces into better options for the customer. I know a good example in Century City in Cape Town. They've converted 2,500 square meters of cinema space into a indoor play park. They're bringing in things like weekend markets and craft markets, brand activations. So the main objective really is to try and extend that dwell time as long as possible. And that's done by creating an environment that there's multiple options for the demographic that they're focusing on.
Well, there are other shopping centres, I think, in the Resilient portfolio as well as Gateway that actually have a fun fair inside the mall, and it's quite significant. It's not your small type. It's an entire section with indoor rides and things. So there's a lot happening in the SA shopping centre space. But Andrew, not all centres are thriving, like Canal Walk and Mall of Africa and Sandton City are actually doing well, but not all are doing as well. We've heard quite a few shopping centres have come on the market, and some of them are poor performing, such as Forest Hill, which was one of those that were on the market, and that's in Centurion in Johannesburg. What are your general thoughts around this?
Yeah, so I think, look, obviously there's always going to be centres that are trading, and that's obviously one of the focuses of our business as well, is the trade of or the sale of these shopping centres. Things like rising operating costs, there's increased costs of diesel used for the generators for load shedding purposes. The retailers themselves are also having to contend with higher expenses in their manufacturing and transport. These are indirectly applying pressure on rentals and renewals with the landlords. So Forest Hill was, as you say, as part of that Robosis portfolio, went under business rescue, and that was a portfolio of retail centres that traded. They had pressure in servicing their debt levels, and they were well above the loan-to-value ratios that the industry and the listed sector are required to stay at. So, when you're being placed under pressure to keep your debt levels down, there's not necessarily budget for improving the common areas and keeping the buildings well maintained, and that has a ripple effect down in terms of your rental rates and the performance of the centre. I mean, we sold just to give you some more insight there, we sold a centre in Port Elizabeth last year called Moffat on Main. It's a 35,000 square metre centre, also a BRP or business rescue appointment. And the reason we had to sell that is because the owners didn't have the funds to maintain the property correctly. They fell behind in terms of the modernising of the tenant mix, and the infrastructure requirements weren't kept up to date.
Well, thanks for that. We don't get to cover the Eastern Cape and Port Elizabeth and East London as well as we would like. So thanks for that insight. As a group, you're national, then you have a presence in most of the major markets.
Correct, yeah. So we have offices in all the provinces, we trade in the Eastern Cape, Port Elizabeth, as well as the major metropoles.
Besides that specific property that you mentioned, any notable other sales that the group has been involved with worth mentioning?
Off the top of my head, we sold a centre in Durban called Moy River, which is, I think, about 15,000 square metre convenience centre. We're busy with 2 transactions at the moment that are under due diligence. The one is a 25,000 square metre centre in Cape Town. The other one's based in Johannesburg. Most of the regional and super regional, the big centres, are normally traded by the listed sector themselves. We normally focus on the what they call the convenience or lifestyle centres, which is your 5,000 to 10,000 square metre or 15,000 square metre centres.
Talking about that, I just saw last week GrowthPoint sold one of its older centers that came into it from one of the acquisitions a decade or two ago. Formerly, I think it was called Game City in Durban, but it's changed its name to City View. And that's relatively small, but it seems like, there is quite a lot of churn in the industry, as it were. And I know the Ritz talk often about recycling assets. But SA reportedly has the 6th highest number of shopping centers in the world. Are we overshopped with malls and retailers cannibalizing each other, particularly in Joburg? I stay in Joburg, and there are some streets where you have several malls in a single street. In the area that I stay, there's 3 spas within 5 kilometers of each other.
Personally, I don't feel there's too many centers. I think we're unlikely to see development of regional and super regional centers in the near future, unless they're obviously on the fringe of a new urban development zone. But we're more likely to see more neighborhood convenience and lifestyle centers, so the 5 to 25,000 square meter centers. Those larger centers are going to rather refurbish and repurpose their space, as you say, and revise those tenant mixes, create those environments to bring in the dwell times. And I think there is going to be competition in the convenience sector market. So as you say, 3 spas next to each other in one road. It's about creating and making sure that these developers and owners have the right anchor tenants in place to ensure that demographic is met, demographic requirements are met, and then the accompanying line shops to complement as well. So it's all about getting that tenant mix right, keeping the building up to date, modern, in line with the consumer shopping experience. And I think, those centers will still continue to perform well.
Just to conclude, Andrew, the interest rate was held last week. Any comments on that? Because that's one of the things, it doesn't just affect homeowners. Many commercial real estate owners have complained that high interest rates are impacting their business. Absolutely.
I think, it's great to see that it stayed on point. In an ideal scenario, we would have seen a 25% basis point reduction, but hopefully that comes in first quarter of 24. From our side, from a trading perspective, it gives stability in the market. Obviously, every time there's a trade, there's a change in interest rates, we have to then renegotiate and engage with our sellers and buyers in terms of the expectations on cap rates and returns. And there's normally a lag between those interest rate changes and the trading times of those assets. So for us, stability is important. I think there's still a lot of pressure on the commercial market in terms of those interest rates, and I think the debt levels are still a lot higher than what we ideally want. Obviously in the private sector, you're looking at loan to value ratios of 60 to 70%. In the listed sector, they're aiming for 40 to 43%. So there's pressure on debt levels, and that's going to put pressure on all the other factors that come into play with regards to maintenance and tenant retention and lease renewals. And it obviously then has a ripple effect all the way down the chain into the retailers.
We'll have to wait and see when that interest rate cut comes, whether it's in the first half or the second half. But Andrew, thanks so much for your time on the podcast today. That was Andrew Dewey, the MD of Swindon Property.
Thanks for listening to the Moneyweb Property Pod with Suren Naidu. To listen to more episodes, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates. Follow Suren on Twitter @Suren Naidu for more of his property industry content and other business stories. The Property Pod.